All right, let's just get right into this explainer. In 2024, Goldman Sachs pulled in an absolutely staggering $53 billion in revenue. Now, if you're like most people, it's pretty easy to assume that this massive mountain of money came entirely from high-stakes aggressive stock trading. But actually, less than half of it did. So how are these financial giants really making their fortunes? Today, we're going to look under the hood and break down the exact engines driving those jaw-dropping numbers.
Here is our roadmap for getting there. First, we'll tackle the Hollywood myth. Second, we're going to dive into the 4 revenue engines. Third, we'll look at how they justify those massive fees. And finally, untangling the financial world.
So, let's kick things off with Section 1, the Hollywood myth versus reality.
If you've ever pictured an investment bank as a chaotic room full of guys in sharp suits just screaming at glowing screens, well, you're definitely thinking of the Hollywood version. Movies like The Wolf of Wall Street or The Big Short, they paint this really exciting but honestly highly misleading picture. That old pre-2008 myth of banks just wildly gambling their own cash, it's mostly dead. The reality today is that regulators crack down hard. Because of something called the Volcker Rule here in the US, banks face strict limits on making speculative bets. When they trade today, it's almost always on behalf of a client. We're talking pension funds or massive corporations. They really aren't just gambling their own cash on where the market goes next.
So, if it isn't a giant casino, what exactly is it? Let's move to Section 2, the 4 revenue engines.
Engine number 1 is M&A, or Mergers and Acquisitions Advisory. This is your classic, high-powered investment banker job. You see, when one company decides to buy another, a bank gets hired to manage the entire, super complex process. They value the target company, they negotiate the terms, and they legally structure the deal so it doesn't suddenly turn into a massive tax liability. They are quite literally holding the client's hand through months of incredibly tense back-and-forth negotiations.
And the fee for all that handholding? It isn't just a flat rate. It's actually a percentage of the deal. For smaller deals under $10 million, the fee is a pretty hefty 5 to 10%. But for mega deals over $1 billion, that percentage shrinks down to between 0.5 and 1.5%. Now, that might sound tiny, but let's do the math. 1% of $1 billion is $10 million, just for advising on a single deal. Plus, it's a winner-takes-all game. Once a bank advises on one deal, they build trust, and they're going to get the call for the next one. This dynamic right here is exactly why Goldman Sachs ranks number 1 globally in announced and completed mergers in 2025.
Which brings us to engine number 2, underwriting. This is what happens when a company wants to raise money, whether that's by issuing bonds or by selling stock to the public for the first time in an IPO. Now, the crucial thing most people miss here is that the bank doesn't just help sell the shares. They actually buy the shares from the company first at an agreed price, and then they try to resell them, putting their very own balance sheet at real risk. If the resale flops, the bank is stuck holding shares that nobody wants.
To really grasp the sheer scale of underwriting, just consider this number: $75 billion. That was the amount raised in the historic SpaceX IPO on June 12, 2026, on the NASDAQ, which valued the company at an unbelievable $1.75 trillion. To pull off the largest IPO in history, a syndicate of 10 banks had to share the immense underwriting job, led by Goldman Sachs and Morgan Stanley.
Because taking on the risk of an IPO is so substantial, the rewards are too. For the heavy lifting of taking a company public, banks typically earn a fee of 3 to 7% of the total amount raised. But for bond issuances, which are considered much safer and highly standardized, those fees are generally sitting under 2%. All right, let's look at engine number 3, trading and market making. This is going to clear up absolutely the biggest misconception about modern Wall Street. It is not about directional betting, trying to predict if a stock goes up or down. As we just learned, they don't really do that anymore. Instead, it's about market making. This is the real volume business that generates the cash. And the airport currency exchange booth perfectly explains this. Think about it. That booth at the airport, it isn't predicting whether the dollar or the euro is going to rise tomorrow. They really don't care. They are just always ready to buy or sell, and they pocket the tiny gap, the spread, between the buying price and the selling price. A modern investment bank does this exact same thing thousands of times a day. So when a massive pension fund needs to sell $500 million of stock without crashing the market, the bank handles it, profiting from that tiny spread. It's a small margin, but at an enormous scale, which brought Goldman Sachs almost $35 billion in 2024. Finally, we have engine number 4, asset and wealth management. This is the least flashy, but arguably the smartest model of the whole bunch.
Unlike M&A, where a deal closes and the bank has to go hunt for the next one, wealth management operates much more like a subscription. Banks charge a recurring annual fee, usually around 0.5 to 1%, to manage money for wealthy individuals and institutions. They get this regardless of whether the broader market goes up or down. This incredibly stable engine brought Goldman over $16 billion in 2024, as they managed over $3 trillion in assets.
With all four engines running, let's pivot to Section 3, justifying the massive fees.
When you hear these revenue numbers, they can sound completely detached from reality. So let's ground these abstract billions in a really concrete example. Imagine a company gets acquired for $10 billion. If the advising bank charges a standard 0.75% fee, which is pretty typical for mega deal, that comes out to $75 million for a single transaction. And this is for work that is often wrapped up in just 6 to 12 months by a team of maybe 20 to 40 bankers. The staggering scale of that pay really hits home when you compare that single $75 million deal fee to the median U.S. annual salary, which is roughly $60,000. One deal literally equals more than 1,200 years of an average person's salary. It's exactly why outsiders assume bankers are just wildly overpaid for pushing paperwork, which naturally leads to a very skeptical question that anyone would have when confronted with those kinds of numbers. Why can't someone do this cheaper? Right? Why hasn't a scrappy tech startup swooped in to offer these exact same services for a fraction of the cost?
Well, the answer lies in an economic moat built on 4 unbreakable pillars. First, relationships. CEOs aren't going to hire a random app for a $10 billion deal. They're going to call a banker they've known and trusted for 15 years. Second is distribution. Big banks have direct pipelines to thousands of institutional investors who are ready to write enormous checks fast. Third, they have the balance sheet, capital, tens of billions of dollars just sitting around ready to absorb market risk. And finally, trust. When making the biggest financial decision in a company's history, clients demand a track record of absolute confidentiality and competence, not the lowest bidder. Put all 4 of those together and you have a business that's almost impossible to disrupt.
Let's move to our final section, untangling the financial world. People constantly throw around terms like commercial bank, hedge fund, and investment bank as if they're the exact same thing. But they really aren't. A commercial bank, like the branch near your house, takes retail deposits and hands out car loans. A hedge fund is a private firm that actively bets on markets to generate high returns. That's the gambling image people usually have in their heads. An investment bank does neither of those as its core business. Yes, massive firms like JP Morgan blend commercial and investment banking under one roof, which totally adds to the confusion, but they are fundamentally different businesses. When people criticize banks for reckless gambling, they are usually confusing them with hedge funds or remembering practices that died back in 2008.
To solidify everything we've covered today, let's pin down a really clear definition. An investment bank is a facilitator for deals, fundraising, trading flow, and managing institutional and wealthy clients' money. They are the crucial deal makers and basically the plumbing of the global economy, connecting capital to the companies that need it.
Which brings us to our final thought. Now that you've seen the highly structured, highly regulated reality of these 4 revenue engines, here is a question to consider. Will the public's perception ever actually catch up to the post-2008 reality of Wall Street? Or will the Hollywood myth of the screaming, reckless trader forever define how we see the financial world? Thanks so much for joining this